nothing goes to the moon without a 50% drawdown along the way. I do look for a global recession, gold taking off from here, maybe a little bit lower in the short run, but taking off a lot from here, getting to $10,000 an ounce faster than people expect, and the war getting a lot worse before it reaches a final stage, but the final stage will be pretty dramatic.
By the way, inflation is not rising prices. It's an increase in the money supply. And look at what M2 is doing. It's going through the roof. I think people need to think about that for a moment. And I think that, this is a situation where as the price has been getting destroyed, the smartest money in the world has been standing for delivery at record levels, whether it be the central banks or whoever's doing here on COMEX.
Financial markets rarely experience explosive long-term expansion without first undergoing severe intermediate drawdowns. Historical fractal patterns in raw commodity trading demonstrate that sharp price pullbacks systematically establish necessary structural floors right before historic breakouts occur. Prominent global economist Jim Rickards, together with precious metals specialist Andy Schectman, assert that an impending global recession will inevitably trigger an unprecedented rally across hard assets. Rickards predicts that after establishing a firm short-term floor, gold will accelerate toward $10,000 per ounce far faster than mainstream financial consensus anticipates. Concurrently, escalating geopolitical conflicts are projected to worsen significantly before reaching a decisive final stage. True inflation remains driven by relentless money supply expansion, as evidenced by accelerating M2 growth. From an independent analytical standpoint, market participant anxiety during price dips creates a classic misdirection play. While paper markets shake out weaker hands, sovereign entities aggressively claim physical bullion. Understanding this structural dynamic allows astute investors to recognize current pullbacks as high-probability accumulation zones before the next macro wave begins. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The recession's coming. As far as gold price is concerned, it's very easy to explain. So when we last met, when we met in Amsterdam, gold was in the 4,000s, but by the end of January, it was at an all-time high. It depends on the ticker, but $5,300 per ounce. Some quotes are a little higher. It depends on what ticker you were looking at, but I'll say 5,300. It dropped. Since then, it has dropped all the way to about $4,000 an ounce, up a little bit as we speak, but it seemed to find a floor. It hit $3,900 an ounce, right around there. That's a 25% drop. But if you pick a base, say $1,800 an ounce, which was not too long ago, less than 2 years ago. So if you take $1,800 as a base and then go up to $5,300, okay, so take that as your gain and then take half of that. That's about where we are in terms of basically 40% decline giving up 40% of the gains since that baseline of about $1,800. I talked to Jim Rickards about this years ago, and probably the greatest commodities trader of all time. And he said to me, this is when gold had peaked. The earlier peak was about $1,900 an ounce in August 2011. We were talking. It was around 2013. Gold had come down a lot, and Jim said to me, he said, nothing goes to the moon without a 50% drawdown along the way. And if you don't know that, or you're not prepared for that, you should not be in that commodity. But then we can take a look at fractal mathematics, basically Benoit Mandelbrot, and he introduced a concept called scale invariance. And what it says in volatile systems, if I gave you a 1-week chart and I gave you a 10-year chart, and I just took out the timeline, so you're looking at two charts with whatever scale, whatever timeline, but you don't know which is which. The charts are the same. In other words, that kind of the volatility you see in a 10-year chart repeats on a daily basis. That's what we mean by scale invariance. So taking Jim Rickards' point, which I think is exactly right, and applying it to the current context on a smaller scale, because we're starting not from $250 an ounce, but like $1,800 an ounce. That's what we're seeing. We're seeing one of those drawdowns. Now, based on that, how low could it go? My estimate, this is not a forecast, but it wouldn't surprise me to see gold go to $3,600 an ounce. That would be the base, a full 50% drop from the prior base of 1800, as I described. That's what the math would say. That's what history would say. It won't necessarily get there, but that's a pretty hard floor. But from there, it takes off. So, just if you don't have your gold, get some now. It's a good entry point. If you do, hang on, because the fund's just about to begin. We've seen our 50% drawdown off a base of 1800 relative to 5300. It's how these things go, and it's going to go up. Now, what were the catalysts for this? So I described the math and the volatility and the history of commodities price movements. And I think Jim Rickards got it right, and I know Mandelbrot got it right. So I'm just applying those insights. The fundamentals on gold haven't changed. Net global mining output is flat. Demand is growing. The safe haven aspect of it is still there. There is a temporary blip because some people are selling gold to get dollars to pay for oil. That will change. And then I think we've had our drawdown, so we got that behind us. And I think we'll be off to the races. So I do look for a global recession, gold taking off from here, maybe a little bit lower in the short run, but taking off a lot from here, getting to $10,000 an ounce faster than people expect, and the war getting a lot worse before it reaches a final stage, but the final stage will be pretty dramatic.
Does a hawkish Fed who only controls the overnight lending rate, will be able to do anything meaningful? I don't think they can. They don't control the back end of the bond market. And just to put an exclamation point on that, come January when the Genius Act moves, all money movement in U.S. dollars will be backed by U.S. Treasuries 90-day or less, short term. So they're going to pin the front end of the curve to the floor, which destroys the dual mandate of the Fed, almost like he's going after them in that respect, issued by the Treasury, not by the Fed. And I just think that it's an issue that is overlooked. If the Fed comes in and overtly issues yield curve control, where they're quietly buying the back end of the bond market to hold prices down, well, that's about their only option, because I don't think their ability to do anything with the front end is going to matter at all. And especially once the Genius Act goes into place and, maybe Trump is out to get the Fed. Warsh already said he wants to do away with the full employment mandate. Well, if you destroy the interest rate mandate or the ability, look, if the 90-day Treasury is pinned to the ground and the overnight lending rate goes higher than that inversion, there won't be a bank in the country that will lend money out to the public. They'll just send it back to the Fed and earn a higher rate of interest with no risk. So this is an interesting time, a very interesting time. And, people focus too much on price. By the way, inflation is not rising prices. It's an increase in the money supply. And look at what M2 is doing. It's going through the roof. I think people need to think about that for a moment. And I think that, this is a situation where as the price has been getting destroyed, the smartest money in the world has been standing for delivery at record levels, whether it be the central banks or whoever's doing here on COMEX. And, if price was relative to value, then why are they doing this? These people are spending billions of dollars. Do you not think that they have an idea of where this is ultimately going? And they're using price as a tool of misdirection. They truly are. So that's the biggest takeaway for me in all of this, is that I think there's a lot of danger in a market when you see the heads of credit in the two biggest hedge funds out there, BlackRock and Blackstone, are two of the biggest in the world, resign at the same time. Same time, the FDIC warns of problems with the banks and the private credit market. There are problems out there, and I think having some protection outside the system has never been more important. And whoever is standing for gold here in the United States and the central banks are showing you that they are accumulating the one thing that they can't print, and doing so at a level no one's ever seen, and not being honest about it as well.
Federal Reserve monetary policy faces severe structural constraints because central bankers only manipulate overnight lending rates while remaining completely impotent over long-term bond yields. Pending legislative shifts mandating short-term Treasury backing threaten to pin front-end interest rates to the floor, effectively neutralizing central bank monetary intervention tools. Should overnight borrowing rates rise above pinned Treasury yields, commercial banks will immediately halt private sector lending, depositing excess liquidity directly back into central reserves. To head off systemic collapse, monetary authorities will inevitably enforce covert yield curve control by purchasing long-duration treasuries to suppress yields. Critically, Abrupt leadership departures across premier global asset managers, alongside official regulatory warnings, signal mounting stress in private credit markets. Observant market analysis indicates that paper price suppression is being leveraged as a tactical screen, while smart capital quietly secures unprintable gold outside vulnerable banking architectures. Now, let's get back to the interview.
One thing that gold has not been driven by is inflation. It has been driven by safe haven demand, the desire to get out of U.S. Treasuries to some extent, because the EU has been trying to steal Russian assets. Iranian assets are frozen. Countries, I should say, are more concerned that the U.S. will use its control of the dollar and the U.S., not so much the dollar, but U.S. Treasury securities ledger controlled by the U.S. Treasury and the Federal Reserve to freeze assets. And people say, well, what happens if the U.S. wakes up and decides they don't like what I'm doing? So maybe I ought to get some gold to offset that. So and mining output is flat. I'm not saying peak gold, but maybe it is peak gold. I mean, I've invested in a few mining companies. I know just how difficult it is to find high grade deposits. It's getting more and more difficult. So putting all that together, the price of gold has been moving on fundamentals, but we haven't had that much inflation. And then the last thing I'll add, Alexi, I said, later this year, maybe, but it could be 2027. I'm not pushing it off 5 years. Might push it off, 6 months or 1 year. But as we mentioned before, people go, well, Jim, gold has struggled to get back to $5,000 an ounce. How's it ever going to get to 10,000? Well, the answer is that if you think of $1,000 benchmarks, each one is easier than the one before because you're working off a higher base. So when you go from $4,000 to $5,000 an ounce, that's a 25% increase. That's a pretty steep climb. But when you go from $9,000 to $10,000 an ounce, that's only an 11% increase. That's like a month's volatility these days. So you'll struggle. You get to 5 and you get to 6, but when you get that far, it's going to go 8, 9, 10 really quickly. For the reason you mentioned, Alexei, silver is more difficult to analyze than gold because gold's not good for anything except money. I think it's the best form of money. Your store wealth. Gold is the best, but it's not used for much else. They coat space helmets with it and some, 5.9s wiring. But I've been in all the big refineries and talked to the top people about it. That's pretty scarce, but gold is incredibly valuable as a store of wealth. Silver has a lot of industrial applications, and you mentioned some of them, electronics, catalytic converters, and other inputs, and it's a precious metal. So you've got two vectors. They can both be going up or down, or one can be going up, or the other one up on the first one's down. So you have to take that into account. But I would say both vectors are pointing higher, meaning the industrial vector is going to give silver a boost because there's so much more defense spending and electronic spending. We're talking about hardware, not AI software. We're talking about missiles and cruise missiles, hypersonic missiles, anti-missile missiles, and a lot of other applications, and drones, which the U.S. is ramping up, but so is Europe. Germany's talking about it. So that input will remain strong. And then as far as the precious metals are concerned, silver is along for the ride. It tends to lag gold, but if gold goes up the way I expect, and I think it will, then silver is going to be along for the ride. So silver will do fine.
So everything about the BRICS is cooperative. Even the Shanghai Cooperation Organization, the largest regional military and financial organization on the planet, its namesake is cooperative cooperation. The countries in BRICS are not mandated to follow guidelines. They're in it all in a cooperative manner. And you're seeing that, so to speak, in the way that they're really not all aligned about the war. They are kinda, but they're not. You have some countries we haven't seen anyone come to the rescue of Iran, right? But there are rumors that they're getting weapons from places like China. You're seeing oil still be sold to China and other countries through Iran, and maybe through alternate trade routes through the north-south corridor that the BRICS built. Everything about what the BRICS are doing is cooperative. You see countries like India that straddle the line, and they're the ones that are hosting the presidency next year. Even the presidency rotates each year amongst the original BRICS charter nations, and it was in Brazil last year. Before that, Russia. This year, it's in India. Was in South Africa a couple of years ago, in Russia. So they move it around. Everything is cooperative. But you see countries like United Arab Emirates, who is straddling the line. They pulled out of OPEC. They're still Western allies, but yet they just sign all sorts of contracts with China. And so these nations, they might not be all fully aligned with one another, although you see them in essence not causing trouble with the West or antagonizing President Trump while still building out the infrastructure for the BRICS in a cooperative way. I don't know if that's clear, but I do think cooperation is the key word in all of this, that these countries see a bigger picture and they're aligning with strength in numbers to build out an infrastructure, to a parallel infrastructure, not to challenge or disrupt the dollar, but the more of these things that we see, little by little, it starts to have a profound effect. And I think you will continue to see that. AI is no different. And it's something that's scary. It really is scary. And let's hope that they do it not just in a cooperative manner, but also in an ethical manner. But what's interesting is that what you're seeing in this AI deal is that AI has the ability to, in essence, plot for itself. It's learning, which is the scariest part of all.
Precious metals are entering a fundamental phase transition powered by urgent safe haven allocation rather than temporary inflation spikes. Global central banks are aggressively divesting from Western Treasury ledgers to insulate sovereign reserves against asset freezes, accelerating physical bullion demand while global mining output remains flat. Discovering high-grade mineral deposits has become exponentially harder worldwide, signaling a structural ceiling on new supply. Mathematically, advancing through $1,000 price benchmarks becomes remarkably smoother at higher valuations. Moving from $9,000 to $10,000 requires only an 11% market move. Consequently, once key resistance breaks, gold will rapidly achieve five-figure targets. Simultaneously, silver benefits from a dual tailwind. Combining monetary momentum with explosive industrial demand across defense technologies, hypersonic missiles, and hardware manufacturing. Geopolitically, the expanding BRICS coalition continues constructing a parallel cooperative economic framework with alternative trade corridors to bypass unilateral monetary sanctions. Concurrently, rapid artificial intelligence developments inject unprecedented macroeconomic volatility as self-learning algorithms develop autonomous decision-making capabilities. In our assessment, surviving this rapid structural evolution requires establishing direct ownership of tangible physical assets outside precarious digital financial systems before systemic realignments take full effect. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.